because we are now back up about that 20,100 mark. And I think inching closer to 20,200 on the futures. Bank Nifty looking quite solid at 150-point gain. So from the banking index, Industrial Bank is something which I would highlight at current levels. The stock has confirmed a breakout already above the 1400 levels. Looks quite charged up in terms of a breakout. So would be quite keen to buy the stock as well as recommend to clients.
Okay, IndusInd Bank, that's a buy coming in from Kunal. Naresh, what's the first trade that you're punching in?
Looking at Bharti Airtel for a slow and steady move towards the 960 mark.
Okay, that's Bharti, which is a buy from Naresh, and IndusInd Bank, a buy coming in from Kunal this morning. Let me just refresh the screen and see if the F&O trades have trickled in and what is the liquid universe up to. While the Nifty has made a good start above the 20,100 mark in trade, we'll give these rates a little bit of time to trickle in. But we have with us Anand Shah, the head PMS and AIF investments at ICICI Prudential AMC, joining in on the show right now. Anand, hi, morning. Great to have you today on ET Now. Anand, what's the take on the market? I mean, there's such a dichotomy between the opinion now on what the mid and small caps are up to and what the large caps are doing, right? First, let's start off with the large cap universe. You think good to go for more headroom, the market at an index level, or do you think that's also getting a little bit overheated?
And all the viewers, I think, look, the difference, while we internally say that the values are at new high, the valuations are not. When I'm saying in the context that when you compare today's market with, say, October 2021, I think while the levels might be similar or a little higher than that, the earnings have significantly improved. So I think the key difference this time around when the markets are touching new highs versus the times when you generally worry is actually the markets are chasing earnings this time around. So we have had a very solid last 3 years in terms of earnings growth rate, obviously with some hiccups here and there in some segments of the market, but otherwise, all in all, at the Nifty level also, the earnings have been supportive of the market to continue to inch up. Having said that, I think we have seen a very, very sharp rally in the markets on the back of both domestic and global liquidity. So it is very, very prudent to say that while the earnings are strong and to that extent fundamentals support it, but the risks reward are not as favorable as they were in last 2 to 3 years. So to that extent, one needs to be careful of what one is buying. And rightly you said large caps today looks a little much relatively safer than mid and small cap, where the rally has been much sharper.
What is stopping you from, let's say, raising cash, sitting on sitting on cash levels where you will get an advantage if markets go down?
Sorry, I missed the initial part.
No, what is if your view on the market is not that great, whether it's large cap or mid cap, what is stopping you from sitting on high cash levels so that you could benefit if markets go down?
I think good point, and the point being that, as I said, the fundamentals are supportive, and when you're picking up companies, you're picking up stocks, there are enough and more opportunities. So the question is it the levels where we are not finding ideas? Is that the levels where we need to significantly raise cash in the portfolios? No, that is not the point. As we were discussing a while back in this channel itself, that the banking still looks very, very comfortable in terms of valuations. Certain utilities still look comfortable. Even to some extent, autos and IT is also corrected. So to me, overall, on the valuations front, we are still finding select opportunities. So to that extent, it's not an overheated market. So again, repeat, while the values are at new high, the valuations are not. So it's not that concerning that I need to raise significant cash in the portfolio at this point.
One of the theses you follow is that buy companies which are going through temporary headwinds, buy sector right now where there is, in general, the mood is bearish. Where are you finding this combination of under ownership, a temporary disruption, and perhaps attractive valuations?
So again, when we are at the markets are at the new high, yes, there is general optimism across the economy. So when I'm talking that relatively where the perception of the market is different from the reality. So we keep on looking where ideally there should be earnings surprise as market is. So again, coming back, I think telecom is one segment where there has been a significant consolidation. Last 10 years have been struggle in making money, but I think we have reached a point where the industry is fairly consolidated. So we should see surprises there in terms of pricing uptick. And again, not in next 3 months or next 6 months, but as we go ahead over next few years, you will see more pricing uptick, better cash flows in these businesses. Similarly, banking is also, since the AQR in 2015 has come a long way. So we had asset quality review, you had Demon, GST, RERA, NBFC crisis. The banks have provided for that, and it got stress tested, really stress tested both in SME and retail during the COVID wave 1 and COVID wave 2. So I think banks are also coming out of a very long, painful period, and there also we are seeing now twinfold advantage of one, significantly lower incremental slippages, but also recoveries from the past slippages. So there also the credit cost seems to be benign, and that's also supportive of the banks looking up. So yes, there are enough and more opportunities where the perception and the reality, there is a good gap, and that's what we can capture.
Right. Anand, I want to specifically talk about manufacturing, right? Because that seems to be the go-to story when it comes to India. And in particular about aerospace, defense, railways. Does it seem like these pockets are getting overheated?
Indeed, this is another area where, again, the perception reality gap was very high 3 years back. Our portfolios were overweight manufacturing and manufacturing allied businesses for last 3 years, while we are significantly underweight consumer. There has been a decent re-rating in this segment. People are warming up to the opportunities that exist in manufacturing. Rightly so, people were not interested 3 years back because we had, prior to that, a decade when manufacturing really struggled in this country. I think many efforts been made from Atmanirbhar to PLI, and also the balance sheets have strengthened a lot. On top of it, recovery in domestic consumption, but also the exports opportunities in the form of China plus one, Europe plus one is also playing out in specific companies and sectors. So manufacturing is a very, very wide segment. We are again looking at multiple sectors and multiple companies. One of the reasons why we're seeing a much more interest in mid cap and small cap, because in India, the large caps have very little manufacturing. A lot of large cap companies are banking services, IT services, pharmaceuticals. Autos are again consumer facing autos and consumer businesses. A lot of real manufacturing is sitting in mid cap and small cap, and that's why we are seeing more and more excitement in that segment of the
Where do you think this entire volatility of the election cycle would kick in? Today we are not talking about it, but soon we'll start talking about it. Historically, we've seen that the election cycle in India is always a swing event. It's not a binary event, but it's a swing event. What should one do?
I think our experience of last 20, 23 years that I've been in the market and what we have learned is, I think, notwithstanding the macro risks that exist always in the market, I think focusing on stock picking, focusing on identifying right businesses has actually paid off very well. To be very honest, many of macro risks were much bigger, had a much larger impact than elections, be it global financial crisis, be it more recently COVID. I think there would always be external forces which will push down markets, and one needs to be cognizant of that. And that's why the asset allocation of an individual is very important. But sticking to the basics, sticking to the right businesses who can withstand the volatility, both macro and micro, and then come out winner out of it. So we have seen even in this cycle, it's not very, very, what would I say, symmetric up move in the market. We have seen significant divergence. We have seen manufacturing, which has survived, has done extremely well, whereas many consumer-facing businesses have not created any wealth. because they were fully priced and they're actually at the receiving end of a very high inflation. So very clearly sticking to the basics, identifying good businesses run by decent management and at the right valuations. BMV is what we call it, business management valuation, that will work. And something which is a macro-led volatility is, I think, something one needs to be mentally prepared for and has to factoring in one's asset allocation.
Led volatility. And Anand, morning, just to stretch that point a little bit further, we were discussing earlier this morning how the undertone of the market, despite the bumps along the way, does seem to remain positive by and large. Do you believe that it is only if we do see some sort of a major event globally that's quite negative, that would really alter the course for our own markets, and otherwise we are looking to build up on the momentum that we're currently seeing?
I think very good question. I think this is very, very important question, that do we see this market rally as one of those, sentiment-driven rallies or a flow-driven rallies and should sell off? I think that's clearly no. I think after a very long period of time, we have many elements getting aligned. While the Indian consumer story is not lost to anybody, Indian consumer has been doing well for last couple of decades. You have a large middle class population where the dependency ratio is falling, per capita income is rising. So obviously Indian consumer story is not going anywhere. Notwithstanding, there are some rich valuations and unreasonable expectations from those companies which are causing some pain in those stocks. But the Indian consumer story is not lost. I think the new story over last few years, where is a significant focus on manufacturing, that was the missing link. I think that's also now at a verge of even the private sector capex. We had many of false starts, but looks like at last, led by government capex, we will see some crowding in of the private sector capex also. So if I see broadly, I think today more number of businesses in India are doing well than less, which was not the case prior to 2020, when a very significant part of the economy, which was manufacturing allied, was struggling as China was the factory for the world and was exporting deflation into the world, which made manufacturing very difficult business to be in. I think that's changing. So to summarize, I think this is the market which has strong legs of earnings. One is to be very, very focused. One is to be very, very careful and continue to buy the right businesses which will benefit from a multi-year growth, which is a possibility, very clear possibility, as the stars are aligned today.
Anand, such a pleasure having you on the show today. Thank you so much for taking the time out and sharing with us your opinion on the markets.
Thanks for having me.
Okay, let me just revisit, in fact, what the market has settled in at. Given that we've clocked a record high on the Sensex, that's also joining the bull market party. Just going to refresh my screen. The Nifty as well, holding put at the 20,185 mark now, by the way, on the Nifty futures. You've got a Balrampur Chini. We were just flagging out a note on the entire sugar pack. Look what's happening within the sugar space right now. A 4.25% bump up is what you're seeing on Balrampur Chini. LIC Housing Finance, that's another liquid mover today. 3% higher there. Bharat Forge is looking very strong. Sona BLW has gapped up as we speak. Remember, after the Piyush Goyal commentary coming in, that Tesla is going to be using more and more Indian competence for their cars from here onwards. So both Bharat Forge as well as Sona BLW, as per reports, already are component suppliers to them. So these are the ones which are scaling up very, very smartly in trade. There's, of course, Birlasoft, Godrej Properties. I mean, we were just talking about the deal for Bombay Dyeing, the other Mumbai-based player that's also seeing excitement. Bombay Dyeing, of course, is, seeing a double-digit 16.5% uptick. And this is, I think, after an 18% move that it started off the day with. But Godrej Properties has scaled up 2.5%. And I won't be surprised if you've got some positive rub-off on even a macro tech developers. Remember, these are specific Mumbai, Maharashtra region realty plays. That's also holding up over 1% as we speak right now. But in fact, since we're talking about the markets, let's hear out what some of the market experts are making of the elevated levels in the market. We've got opinion coming in from the who's who literally on D Street, Purinju Veliat, Vijay Kedia, Sunil Singhania, as well as Gautam Shah on the technicals.
Exuberance is very much evident, Nikunj, in my opinion, in these railway and defense companies. But again, I believe this is these companies are in that long haul moment, with a long runway. So so there can be, some of these great companies with great future. There can be correction, and it can price-wise correct 20-30%.
Every time people come in this market with a new theme, with a new dress and new concept, and ultimately that concept lasts for maybe 6 months or 1 year, or maybe 2 years sometime, and then they fizzle out. I'm not saying the story in those stocks are over. The story may play out maybe for a decade or so, but valuation is too high and there is euphoria in this market. I will not buy those shares, and this is what I can say.
I would definitely urge that this is not the time to just blindly get into something because there's a name defense or a railways or a shipbuilding or an EMS attached to it. Be discreet. There is, as I said, a lot of opportunity in these sectors.
Whenever any rally becomes parabolic, it usually does not sustain, and that's clearly happened in defense and railway. And we have been recommending aggressive profit booking in both these spaces in the last few days, and we continue to recommend the same, because I think this is just crazy, because people are just factoring in too much into the future, discounting too much into the future, which I don't think is right.
We have invested into these themes, maybe in some of them we have got into quite early. Now at the moment, what are we doing? At the moment we are not selling out of these themes, because we definitely understand that these they are supported by strong order flows. I think it is always good from diversification, from risk mitigation perspective, to have good quality 3-4 set of these companies to play the theme, and also it is going to be very difficult to maybe own a significant proportion of these companies due to liquidity not allowing that from a large size of fund perspective as well.
Opportunities or the outlook for both defense and railway is very constructive, and both of them, to my mind, are a decadal story. So I have exposure to stocks like ABB, Siemens, Cummins, some of these defense names as well, including Bharat Electronics, BML, Hindustan Aeronautics. And all of these stocks have done exceedingly well. But clearly, if you ask me, over the next 24 months, I think therefore next 24 months earnings prospects or growths are clearly priced into these, because these stocks have seen significant or massive P re-rating over the last 12 months, I would say.
Thanks for staying on with us. Yes, we're staring at a print of 20,100 plus on the screens, and it's across the board that you're seeing fervor that's kicked in. So mid and small caps as well joining the party. You've got the advanced decline ratio that's skewed firmly in favor of the gaining side, and lots of stocks that are up to their winning ways. In fact, on the Nifty itself, you've got all stocks that are in the green, barring just about a handful. That's 4 or 5, led by Hindalco, UPL, Wipro, SBI, and Nestle. But let's find out what's going on within the pharma sector as a whole. It's been moderate growth over the last 4 months. Is there likely to be some sort of a trigger down the line? What's the view in terms of individual categories? We've got Vishal Manchanda. He's Senior VP Institutional Research at Systematics Group here to discuss that and more. Thanks much for taking time out and joining in. Just wanted to talk about the overall landscape for the pharma sector as a whole. What do you believe has kept the sector in consolidation mode, and what do you believe are some of the key triggers or growth drivers?
So we have seen a long phase of the sector underperforming other sectors, but lately in the last leg we have seen the sector doing well, the stock prices moving up. But alongside, what we are also seeing some changes in the way various businesses within pharma are performing. So like US, which used to be an underperformer for most companies, has started to do better, partially led by some interesting launches and partially led by improvement in the macro environment in the US. So I would say US has started to move on a positive trajectory. Earlier, it was on a declining trajectory and a cause of concern for most companies because Indian companies have large exposure to the US markets, between 30 to 40% exposure, and it's going higher this year. India, which used to be a secular growth story, while it remains a secular growth story even now, but we are seeing changes in the dynamics within the sector. I think there is some pressure on the branded prescription formulation. This branded prescription formulation piece is probably getting cannibalized by the trade generics business. So this trade generic business is probably growing faster in volumes versus the branded prescription business in India. So that's putting pressure on companies.
Can you break it for us in terms of, let's say, pockets, starting with bulk drugs, API, formulation, injectable? In this entire chain, is the entire chain about to get re-rated like it happened in COVID, or it would be selective within this chain?
So I think if you look at the API space, we are yet to see. So what we have seen so far is we have seen some relief from the pricing pressure, not the pricing pressures, but the raw material pricing pressure. So that's come off now. Second, there was a lot of inventory in the channel that got accumulated during COVID times, both on the API and the formulation front. So even that has come down. So there is some partial relief coming in from there. But if you look at the sector fundamentally, I think there are no we are not seeing growth getting stronger versus what it was in the past. And it would probably be like, again, in pharma, we have companies who would do well and companies which will not do well. So it will not be like a sector-wide outperformance in API. Probably those which have APIs which are in the faster growth region would do well, while those doing APIs which are which represent mature markets, those would grow at traditional growth rates. So it will all be a very selective. You need to pick up things selectively within pharma because within the entire market there are sub-segments like various therapies, various molecules, and each one has got different market dynamics. If we look at the formulation, I think formulation is a mixed. As I discussed earlier, the US has started to do well, so formulation is behaving favorably. Only thing is US, we need to understand what would be the pace of growth. The decline has got arrested, but the pace of growth, I think, will not be kind of high single digit, but maybe in the low to mid single digit range. But that would kind of be good enough for companies, because on top of that, they can launch some interesting assets like companies launched Revlimid last year. And probably if we see other launches happening in the next few years, the US should be able to do better than what it has done in the past. Only area of concern that I see is within the formulation space, it is the India branded formulation space. That's not doing as well as it used to do in the past. So there are some pressures there. Injectable, I think the injectables is yet to recover. We are seeing increasing pressures on the injectable front. Increasing pressures, I mean, there is competition is increasing, capacities are increasing. So that's putting some downward pressure on injectable pricing globally.
Look at the domestic market is a completely different kettle of fish, isn't it? Whether it is monsoon or no monsoon, the domestic sales are strong, antibiotic sales are strong, OTC sales are strong. Do you see the vibrancy in the domestic market to sustain?
So in the domestic market, we know there is a lot of scope for companies to expand access because we still have a large population not getting proper treatment for their conditions. But the challenge what we are seeing in this space is market share is getting shifted. There is overall volume growth in the market. There is overall volume growth, but what's happening is there is a segment called trade generics, which is not. These drugs are not sold through the traditional channel like the physician would prescribe and the drugs would be consumed. They are actually dispensed by the pharmacist, and that segment of the business is growing faster. And the larger Indian companies do not have a very large presence in this space, trade generic space. Only a few of them have a presence in the trade generic category. So that's overall market is growing, but within that, various segments are growing at different paces. That's how it is.
Sure. So, I'm just going through your ratings here. In your coverage list, you have only 2 buys while 7 hold recommendations. And that's only on Indoco and Pfizer. Why is that? What's the rationale behind being positive on just these 2 names?
Right. So it's primarily the valuations have run up, and what we are waiting to what we are waiting for is, like, if you look at the earnings, they've also moved up in this year. They are moving. So Q1, Q2, Q1 was a good quarter for the companies, but there is an element of concentration here. A large part of profits for most companies coming from single product. So what we are waiting for is this concentration to come down and companies launching more products in the US that would kind of make the profit more resilient in terms of not coming down, and basically they can build up from where they are today. So we'll wait for some interesting launches to come up in the US before we redo our target price. Pfizer. On Pfizer and Indoco, we have a buy primarily because there is a valuation room here for these stocks to kind of get re-rated.
What would you say one should do with, let's say, the derivative plays? Like Cipla is a derivative play. Let's keep the buyback news aside. It got domestic presence, US presence, and then it has a semi-regulated market. Same for Sun Pharma. To some extent, I would say that also applies even to Lupin. So is it a good idea to have companies which have 30-40% coming from India, remaining coming from rest of the world?
So most of these larger names have got a diversified presence: India, US, rest of world, Europe, and API business. So quite diversified, but diversification, as you know, also kinds of pulls down your growth. You might be doing well in a certain geography, might be giving you growth, but the other might be pulling you down. So that element actually restricts the growth potential. Sun Pharma is a differentiated asset here versus the others because Sun Pharma has been able to build a business wherein they have the ability to scale up the business to to a different scale. While others are still in that generic space where the ability to scale up is still limited. So overall, I would say, unless companies move out of this generic space, the multiple will remain, will not expand from where it is today. So probably it might also contract because we are seeing pressures, as I said, in the Indian markets. So that's where the changes are happening. The India branded space is getting seeing a bit of slowdown, but companies need to do something on the innovation front to kind of be able to scale up to a different level, become much larger than what they are today.
Okay. There are also interesting patterns which are there if one looks at, let's say, the hospital space. What is happening to the entire pharma retail space? Anything exciting which looks interesting? Because now pharma retail, for example, whether it's NetMeds or some other companies, that's a real sector. You got hospitals which are at a multi-high. Since you track the healthcare space as well, is it time to look at those pockets?
Currently, I do not have a coverage on the hospital space and even on the retail names within the sector. I'm purely focused on the pharma. I'm yet to initiate coverage there, so would refrain from giving my views on these names.
Okay, appreciate your time. Vishal, you've been very generous with your time. Thank you very much for joining us. I'm just going to mark markets now. Now, this is for the second day on the trot now. Markets are building on their gain. So what we saw actually on Tuesday was more like a mid-air turbulence. Remember, if you're going on a long-haul flight, well, you will see mid-air turbulence. The pilot will say, fasten your seat belts. But there is nothing wrong. I mean, that's not a danger. It's just that you undergo some air pockets. And that's the air pocket which I think market had hit, at least in some of the large cap stocks. Now, in railway stocks, defense stocks, power stocks, where excesses had got created, those excesses had to be flushed out. Money making is not easy in equity markets. You have to understand risk and margin of safety. I keep on repeating that. And I think that was the missing link, or that has been the missing link in some of the stocks. But railway stocks, well, where are they today?
All up, actually.
All up, is it?
Yeah, all massively up. I was just looking at the first rates. Look at IRCTC. That, of course, is the 3-month chart. But if you can just pull up the today price action, 5.25% is the uptick that you're seeing on that one. And I think even RVNL is holding out.
RVNL, all up.
They're all up. Ircon is holding up 3.25% the last time I checked.
For the first time.
Yeah.
Yeah.
Normally I have a view on a lot of things, but right now I just, I think Mumbai, see, you cannot go against the market momentum. Because if you go against the mob, the mob's going to rob you. And in train terminology, since we're talking about railway stocks here, if you stand in front of a running train, you're going to get smashed. So railway stocks have momentum. There is no point in jumping against it. You may choose not to jump on the train, but you don't want to stand in front of the train. That is my limited point, since we are talking railway terminology.
Literally, it's that.
Yeah.
Okay, but a lot of other IPOs as well, which are opening up. And we've got 3 on our radar. There's RR Cabel, there's Samhi Hotels, and there's Zaggle Prepaid as well. So, which is the best IPO that you could look at in case you're looking at making that one choice? Somit is here to walk us through the prospects of all 3. Somit?
Well, there are 3 IPOs that are currently there, RR Cable, Sami Hotels and Zaggle Prepaid. Now, RR Cable is looking to raise close to 1,960 crore rupees, while Sami is looking to raise close to 1,370, and Zaggle Prepaid is a bit smaller one, around 560 crore rupees of IPO size is what we are getting in. Now, the for RR Cable, if you see, the OFS is a higher part at around 1,780, where the promoters and TPG are looking to sell stake. In Sami Hotels, it's the fresh issue that is on the higher side, around 1,200 crore rupees that the company is looking to raise, and the amount will be used by the company to repay that debt. And when it comes to Zaggle Prepaid, they are looking to raise close to 392 crore rupees, which is via fresh issue, and they will be using this for customer acquisition and for product development. Firstly, moving on to RR Cable, if you see now compared to peer, the company's revenue growth has been a bit faster, but on the earnings side, the growth has been a bit slower because of raw material prices changing, and because of which, even if you see the company's margins, they have also declined to around 5.8% from 8.3% that was there 3 years back. On the valuation side, RR Cable is a bit expensive. On FY24 valuation stands at around 45 times, but if you see the FY25 valuations, it's at around 35 times, which is comparatively cheaper when compared to its peers like Polycab, Finolex Cables and KEI. When it comes to Sami Hotels, now that company has seen a higher growth rate on the revenue front, at least compared to its peers like Lemon Tree and Indian Hotels. Also on the EBITDA front, the company's growth rate was much higher, but that was also because of a lower base and higher operating costs that the company had seen in the base quarter. Also, do remember, Sami Hotels has been continuously making losses for the last 3 financial years, while its peers are profit making. When it comes to EV to EBITDA, that is the valuation, Sami Hotels is on a cheaper side, around 15 times, as compared to its peers, which are trading in the range of around 20 to 26 times. But this could be also because of the fact that Sami Hotel has been loss making, despite the fact that the hotel industry has reported strong profits in the financial year FY23. And lastly, when it comes to Zaggle, it's a new company. It has no listed peer currently. In the pre-IPO fund, they have raised 98 crore from very well-known investors like Ashish Kacholia and ValueQuest. If you see company's revenue growth, it has been around 32%, EBITDA growth and net profit growth has been a bit on the slower side, but that was because in FY23, the company had around 14 crore of ESOP expenses, which were a one-time cost. Removing these 2 expenses, the net profit growth and EBITDA growth has been fairly better for the company. On the valuation side, if you see, based on FY23 P, if you adjust for the ESOP expenses, the valuation stands at around 60 times, and if you check at the FY24 valuations, they're at 50 times. The company's valuations are quite demanding, but do remember that there are no listed peers, and the business model of Zaggle is quite unique in the industry.
Lot of action in the primary markets. Take your pick, literally. Samit, thanks for highlighting all those details. On that note, we're going to take a very quick break, but come right back. We'll analyze and discuss whether there's value on the table for the IT stocks or not, and we'll have 2 experts join in on that.
Good to have you back with us, just mapping out all the movers and shakers. And yes, much to Nikunj's surprise, those PSU rail stocks are on a tear. You've got the overall market as well that's gotten off to Thursday morning with great gusto. So yes, we're staring at a print of 20,156 on the index, and giving those rail stocks company, you've also got the likes of a Schneider Electric, Balrampur Chini, Avanti Feeds, Gillette as well, for instance. All of those stocks continue to remain abuzz in trade. But IT as well has been a talking point of late. Let's understand a little bit more about the overall valuation picture, the deal win momentum, as well as the kind of results and the commentary that we've seen from some of the IT majors. To discuss this, we've got on board Apurva Prasad, who is joining in, institutional analyst at HDFC Securities, as well as D.D. Mishra from Gartner. Thank you so much, gentlemen, for taking time out and joining in. Let's get in a sense from you first up, Mr. Mishra, as to whether or not now you're seeing perhaps the worst being baked in for the IT space.
So I would not frame it like that, and thanks for having me here. I see it from a very different perspective, and the way Gartner has forecasted the various spending on the IT services, if we look at it, every year we are going to see the growth. Now, this year may be a year of caution, and some of the budgets may have been paused. But next year onwards, we see that return to growth is going to happen. And the IT services spending for the next 3 years is going to be in the double digit, which we have not seen in the past. So I am a bit optimistic from the point of view what we see. In addition to that, I would say that every year, I, as an analyst, go through at least 700 to 800 client situation across the world. And hardly any conversation I am hearing that the client would like to stop their spending. But having said so, I also understand from some of the providers that whatever the pipeline they have forecasted in the past may not be relevant as of now, because of the kind of pause which they see in the market at this point in time. But I don't see that this particular pause is going to be lasting for, in 2024. And we see that, the growth will return in 2024 the way it has been, perceived earlier.
Okay. Apurva, nobody is talking about a slowdown. Large deal wins are there. They were there last quarter. They were there, Apurva, even before the quarter before. But if I look at what IT companies are telling us in terms of their guidance, their outlook, and also their body language, it's not very constructive. So, Apurva, if large deals are coming through, why is that not getting translated into real quarterly numbers?
So, thanks for having me. There's a bit of a disconnect here because, number one, there has been an anticipation of slowdown/recession. If you trace back early part of this calendar year, I think those timelines are probably moving ahead. But I think that there is a sense of caution that enterprises do have because of the slowdown in the overall macro scenario. So that's actually, it's going in that direction. That's one. Second, point on contracting, that continues to remain fairly strong, but you have to see the nature of those deals, which would be very different as compared to some of the deals that you would have seen companies talk about a year back or a couple of years back. So there is definitely a lot more focus on cost optimization. So if you look at most of these large $1 billion plus deal announcements that some of the larger IT companies have made. So most of them are centric around that. So it is building in, number one, some form of caution by enterprises and also cost optimization. Number two, there is a prioritization of projects. So a lot of work which was happening, which was more discretionary, that's not part of the volume or the scope of work. So that, which is why there seems to be like a disconnect. But what we believe that over the next couple of quarters, that should start to normalize as some of the largest spenders continue to allocate large sums towards tech spend. So those numbers are growing still. And the pause in the actual rollout of programs can probably get released over the next couple of months.
Mr. Mishra, that's the other thing. While no one's worried about what the long-term prospects are, especially given the multiple large deals that have got announced recently, right? And 4 of them are these mega $1 billion plus kind of sizes. But it's more the near term. You don't know whether what's happening within IT is a structural issue or is it temporary? And the management commentaries as well don't give you clarity on the same.
And when it comes to actually technology world, it becomes more as uncertain because we don't know what we don't know and how it is going to unfold. Because number of variables are too many, and that is where you will be able to see that some sort of cautious optimism may be there. But at this point in time is more of a rationalization, and there are so many things, shifts in technology which is happening. And there are more things which are going to come. We are talking about at this point in time that how Gen AI is going to disrupt the market. I'm more worried about, how the autonomous business is going to disrupt the market at this point in time. So, optimism, that sort of an optimism will always be there. And also there should be some amount of pessimism will also be there because of these complexities which exist. But I would say that, technology is like a booze. When you are having trouble, you spend more on it. And when you are actually having the good times, you spend on it. So there is nothing much to worry about. Yes, the providers will be a little bit more cautious because they built a pipeline which was used, and they were trying to chew more than they can swallow at some point, especially after the COVID period. It has been kind of, their pipeline as was exploding, and you could have seen the impact on attrition rates, which went up, which has started stabilizing, and it has come down significantly. But having said so, this sort of a challenge, which you have said, is going to continue, and we have to live with that.
So, Apurva, wanted to just understand from you as well as to what the outlook is then, given the fact that we have seen some large deal wins being announced by a lot of the IT majors. Does this increase the visibility for the second half and beyond?
Yes, most certainly it does. It does help the overall visibility near term. We still, however, do think that the second quarter will still be a soft quarter for the sector, and then we do expect normalization 3Q, 4Q onwards. So that's our current base case. And some of these deals, they do give in good visibility, but that's more Q4. And I think what it's going to support is this acceleration back in FY25, because the full impact is really, just it's going to come up in the next couple of quarters. So I think the acceleration in FY25 has come from very subdued FY24. Looks to be a reasonable probability right now.
Mr. Mishra, a very simple question. What would be the impact of AI? Because AI means less manpower. The Indian IT companies up until now have followed a model where you have advantage of scale and skill, and you keep on adding manpower. That is how your billing rates improve. That is how you've been able to grow. But if AI is going to be reducing the workforce, then don't you think this is going to be a reversal for the Indian IT sector per se? The core, in a sense, gets challenged.
So I will agree to disagree over here that Indian IT companies have been solely depending on labor. And now, shift from labor to technology arbitrage is not something new. It has been there for 4 to 5 years now. And I have been seeing this shift very, very closely, and the way it has been impacting their businesses. Now, many of them have been proactively doing creative destruction of their own business and operating models for so far in order to make it happen as well. Because if they don't do it, somebody else will do it, which will have a much, much larger impact on their businesses. So it has been there, it has been optimizing. And if you look at from a client's perspective, what client today is looking for is more value than cost. And somewhere, cost is also very important. It may be number 2 or number 3 priority at this point in time, but the cost, the overall operational efficiency is becoming more relevant for the end customers. And AI is a kind of thing, and the kind of technologies which AI enables will help us to optimize the environment, drive operational efficiency, and at the same time, it can optimize the cost. So it has been there, and it has kind of, dented the kind of top line which they have perceived earlier, or kind of, work impact on workforce, which is there, which already is there, and it will continue to be there. What can happen is that, we will move towards more hyper automation, and then towards the autonomous kind of business models, which are going to evolve from 2025 to 2040 is the era of autonomous business, where even the kind of decision making power will shift towards the machine. We are looking at a kind of, organization where I say that the owner and its dog will be the only one who will be employed, and the responsibility of the dog will be to ensure that the owner doesn't touch anything. So that's sort of a business model. Now, when it will happen, how it will happen, how fast it can, impact the world, it may happen in stages, and in various forms and shapes. But this is the kind of reality we are moving towards. Whether it is a threat or an opportunity, depends on how we look at it and how we leverage it.
So, Apurva, before we wind down, is there value on the table? Should one be buying IT right now? And if so, what are your preferred bets?
Absolutely. I think selectively, most certainly, more than, all out. But yeah, I think that's a stance that we do have. We have a selective stance on the sector. So if I have to name a few stocks within the tier ones, within the large caps, and LTI and Mindtree, I think is certainly an opportunity. If I look in the mid-cap, mid-tier IT, then Persistent Systems, mine. And if one has to look within the small cap space, then Birla Software. I think these would be some names where there is a good opportunity. I think broadly, the mid-tier IT growth outperformance over tier one can continue. Having said that, tier one IT valuations right now are pretty much near the long-term averages. So to that extent, there is some comfort from a valuation standpoint. But at the same time, we do believe that this premium that mid-tier gets on tier one, that's likely to continue much higher levels of sustainable growth.
To sort of stretch that point forward, what would be your outlook when it comes to individual companies? Do you think that we are seeing a catch-up with the mid-cap IT companies to the large caps, or there is going to be a stark difference in performance overall? Mr. Mishra, that question was for you.
Yeah, so see, the thing is that, from a stock perspective, I cannot comment on it. But what I can say that the organizations are going to be impacted by the kind of technology shifts which is happening. Now, we can see more merger and acquisition, more divestment, more the changes in the operating model or the business models of the organization. Some companies will perform, some will perish, and this is going to shift the market. But spending on the technology is going to grow, and it is going to be more and more relevant for the businesses, because the difference between the business and the technology is diminishing, or it has diminished already. And hence, technology is no longer a kind of a choice. It is a kind of a requirement which you need to have in order to perform or succeed. Whether you are in crisis or whether you are having a good time at this point in time, technology is going to be the way forward to take you forward. So that is where I see that, the organizations will change in order to leverage it. Those who cannot change will have to find out something else.
Sure. Okay, Apurva, Mr. Mishra, thank you both of you for taking the time out and joining in today and giving us an overall view of how to approach the IT sector now. Okay, that's that on IT. For the index, we've picked it up, 20,167 for the futures. Nifty spot as well at 20,100 plus levels. And metals, they are the ones which are actually charging up ahead today. So look at the move on a Hindalco. That stock is up 4.5%. NMDC scaled up very smartly, about a 3.5% uptick there. Tata Steel looking very smart indeed there too. About a 3% uptick is what you're seeing on Tata Steel as well. Of course, from within the broader end of the market, it's sugar all the way. Balrampur Chini up 6%. And then, of course, there's Birla Soft as well, which, by the way, was Apurva's small cap reco from within the IT pack. That stock also 507.50 on that stock as we speak right now. The losers then, PNB. After its phenomenal move yesterday, today it's a little bit quiet. IDFC first, Piramal Enterprises, Oro Pharma and Tata Consumer. These are some of the names which are in the red as we speak right now. But let's move on and let's talk about Dixon Technologies. And we have with us Saurabh Gupta, the CFO, joining in on the show right now. Saurabh, hi, morning. Good to have you on the show. Saurabh, Apple is going to be selling now Make in India phones, and reports are suggesting that you are pretty close to signing one global customer. Should we put one into one together and think that it's you?
No. So we are actually not in discussions with Apple on mobile phones. What we said in one of our last interviews that we are in the process of signing with one large customer, one large brand on the laptop and tablet side, basically on the IT hardware products.
In future, is there scope for a breakthrough that you could actually be doing work for Apple?
Yeah, so I can only say that if Apple gives a chance, definitely we'll grab that opportunity with both hands, clearly. But as of now, there is no discussion with Apple on that side.
Phones, as we understand, Saurabh, are of course a predominant component of your product portfolio, right? What is the visibility that you have on your order book right now? Because you've got some reputed customers such as Xiaomi, JioBharat, etc.
Yeah, so our order book on mobile, especially for the second half of this financial year, and more so the Q4 of this financial year, because by that time we should be able to ramp up and stabilize the production for most of our customers. So you're absolutely right. We have a strong order book from all the customers like Motorola, both for the domestic market and also for exports to North America market. Then you said Xiaomi, JioBharat phone, and also we have recently got into manufacturing of phones for ITEL, which is Transition Group, for both feature phones and smartphones going forward. And also Nokia is also a very big manufacturing partner for us, both on the feature phones, where they have a very large market share.
Give me some color on the laptop and tablet opportunity. You said that you're looking at one, or rather working with one large client. We already know that Lenovo as well is one of your key clients, apart from, of course, Acer as well. What's the visibility that you have on the laptop and tablet market?
So it's a very big opportunity. If you look at the total market, it's around $11 to $12 billion, and out of which $9 billion worth of value is imported into India now. Now, with the government putting a restriction on that, and also with this whole PLI scheme coming in, where the government has increased the budgetary outlay, I think so it will trigger the Indian manufacturing. And we have filed our application to the government under the hybrid category, whereby we have committed a capex of around 250 odd crores, and we have committed revenues of almost 48,000 crores cumulatively starting next financial year. And we are really committed to creating a component ecosystem, which is also part of the PLI that is being rolled out by the government.
The fact that there would be restrictions on laptops, is this forcing a lot of global laptop manufacturers to come and stitch alliances with Indian companies like yours?
Yeah, so clearly we clearly see that happening. So the next 6 months, I think so, either the brand owners will set up capacities themselves, or some of the brand owners will look at tying up with players like us. So in the next 6 months, we are hopeful that we already have a relationship with Acer, and we are in the process of getting one more large brand there. So in the next 6 months, we'll be getting large capacities in this. And we think after mobile phones, IT hardware would be the next trigger for our growth.
Any way to establish that how much of manufacturing which you are doing at Dixon, how much of that is consumed, how much of that is shipped outside India, and how much is that for domestic market?
So as of now, exports are very small. So out of last year, if you look at, we did a revenues of almost 12,200 odd crores, out of which 1,000 crores was exported to North America markets, majorly the mobile phones. This year, we are hoping that number should more than double, mainly in the mobile category. But we are expecting that we are also working for some clients on the exports on lighting, as well as hopefully in times to come in washing machine as well. So yeah, exports as a number should keep increasing for us.
So, if I were to look at your product mix as well as, the contribution with regards to the revenue pie, what kind of a picture are we going to stare at, say, 1 to 2 years down the line?
See, I don't want to pinpoint a number, but clearly we are growing very strong. We have a very strong order book. We have taken a larger share of wallet from existing customers, and also we've got some large customers on board, especially in the mobile category. So we think we will outperform the industry, the overall consumer durable industry, by a big margin, and also the whole EMS industry. So we are looking for a very strong growth, especially coming in the next financial year.
No, and a revenue contribution from your various products? I mean, what's going to lead? What's going to be the largest revenue contributor?
Mobile will be the largest trigger for our growth. I think so. Almost 55 to 60% of our revenues by next financial year should start coming from mobiles, and then followed by IT hardware as well as the consumer durable product, the consumer electronics, which is the TV category. So second category would be consumer electronics, and then hopefully it can be the IT hardware.
Margins are same in all the categories. I mean, individual category-wise margins, how are they different?
So we have two business models. In the prescriptive category, margins, which is almost 70% of our revenues, the margins are in the range of 3 to 4.5%. And in the 30%, the balance 30% of the revenues, which is majorly our lighting and washing machine business and some part of our TV business. So in lighting, we enjoy margins of almost 8.5 to 9%. And washing machine portfolio is somewhere between 9.5 to 10%.
And when you speak to your top 3 clients, are they ready to commit to 15-20% growth for next 3-5 years? I mean, are you getting that sense of visibility?
Yeah, clearly with all our anchor customers in all categories, we are taking higher share of wallet. First of all, those customers are growing in those categories, and also increasingly what the customers are clearly looking at outsourcing more and more manufacturing from either their own facilities or from other EMS partners to us. So clearly, in our case, the growth will be strong, mainly on account of these two parameters. One, adding new customers, and taking higher share of wallet from your existing customers.
Right. Great to then have you on the show. Thank you so much for taking the time out and speaking with us.
Thank you very much. Thank you.
Okay, that's the word coming in from Dixon Technologies. Extremely robust on what the future actually holds for them. That stock holding very steady, about 0.5% uptick there. As is the market as well. We're maintaining that 20,100 level, both on the futures as well as the spot. Eased off a little bit from there, but nothing alarming so far. We'll take a very quick break. Lots more lined up on the other side.